Welcome to the Depth Dive. Today, we are really tearing into, well, a stunning outlier in an industry where growth is often, flatline or even shrinking. We're focusing on IBEX Ltd, ticker IBEX, and the results they dropped after hours back on September 11th. This covers their fiscal year 2025 fourth quarter and the full year.
Yeah, and this deep dive is absolutely necessary because this report caused a serious jolt in the market. The business process outsourcing, the BPO sector, it's been fighting a lot of skepticism lately. Things like labor costs, the whole AI threat.
Right, the existential questions.
Exactly. But IBEX,
Yeah.
they delivered a clean beat. It was driven by phenomenal operational execution and critically, really superior cash generation. This is looking like an AI-driven growth story that the market is, well, finally starting to recognize.
Okay, let's jump right into those numbers then, because they were immediate headline grabbers. We saw a powerful beat, top and bottom line for Q4.
We certainly did. Q4 revenue came in at $147.1 million. Now, that might just sound like a number, but in context, that's an 18.2% jump year over year. And it absolutely smashed the analyst consensus, which was sitting somewhere around $132.9 million.
Huge beat. And the profitability, the EPS.
Followed right along. Non-GAAP adjusted earnings per share, the adjusted EPS, it rocketed to $1.87. That's a massive 50% increase compared to the same quarter last year. Just crushed the consensus estimate of 50%.
That's EPS growth. Wow.
And this is where we need to pause and talk about the quality of these earnings. They reported record quarterly free cash flow, FCF, of $22.8 million. Look, this FCF figure is the crucial underpinning of the whole investment thesis.
Well,
Really.
why is that so critical in BPO specifically?
Well, think about it. BPO can be capital intensive, relies heavily on global labor. A lot of competitors are highly leveraged, or they struggle with working capital. IBEX, generating record free cash flow, piling up cash. It provides significant de-risking. It gives them optionality that, frankly, few of their peers have.
That's a great point. It's not just growing the top line, it's turning it into actual usable cash. So using that Q4 crescendo as a springboard, what did the full fiscal year 2025 look like overall? Did the momentum hold?
Oh yeah, the full year really solidifies it. Total FY25 revenue hit $558.3 million. That marks a robust 9.8% year-over-year increase, almost double digits for the full year. And because of that strong execution and, let's be honest, some pretty aggressive capital management, the adjusted EPS for the full year reached $2.75. That's up 30.7% from FY24.
Okay, that 30.7% jump in per share earnings is exceptional. But let's dig back into Q4's revenue for a second. Where did that 18% growth actually come from? Was it like one giant client win or something broader?
No, it was definitely broad-based, which indicates, good diversification and strategic strength. The biggest lifts came from these high-growth verticals. Retail and e-commerce led the pack, up 24.5% year over year. HealthTech grew 19.0%. And travel, transport, and logistics, that was up 10.0%. Management also specifically called out what they termed outstanding growth in their digital acquisition business, too. That signals a strong pipeline,
Right. The vertical strength is important, but you mentioned strategy. It feels like how they deliver these services is the real margin story here. Let's talk about that geographic and service mix shift.
Yes. That's where the analysis gets really interesting. Their margin durability, it's a function of geography and service type. You see, BPO traditionally relies on labor cost arbitrage, right? You move operations where labor is cheaper. IBEX is leaning hard into that advantage. Offshore revenue now makes up 49% of their Q4 total, and that piece grew 17% year over year.
Okay, so nearly half their revenue is now offshore, and that part's growing fast, accelerating the shift to higher margin regions. But what about the services themselves? We hear omni-channel thrown around a lot. How's that actually helping the margins?
Because they're successfully moving up the value chain. That's the key. Their focus is on digital and omni-channel services. These now account for 82% of total revenue. Think of this as capturing higher value interactions. It's not just simple tier 1 calls anymore. It's stuff like product enrollment, complex tech support, managing the whole customer journey. These digital and omni-channel services, they grew 25% year over year. That's a huge transformation from, 65% contribution when they IPO'd just a few years back.
Okay, let's pivot to the strategic narrative then. The CEO, Bob Dechant, he's framed this as moving from BPO 2.0 to BPO 3.0. Now look, we hear BPO companies talk about AI constantly. Is the market sure this isn't just, marketing fluff? What proof points show IBEX is truly further along with AI?
That's the critical question, isn't it? The investor skepticism. And management, they addressed it head on. The key differentiator for this BPO 3.0 idea isn't just using AI, it's the seamless integration. BPO 2.0 was about optimized labor arbitrage. BPO 3.0 is defined by the AI integrated customer experience. Dechant really emphasized that this past quarter marked a definitive shift from proof of concept for our AI solutions to full-scale deployment.
Full-scale deployment, that suggests real-world impact, not just experiment.
Precisely. They're leveraging AI internally for efficiency, sure, but also externally with AI agents for the less complex interactions. Crucially, they've built what they call a seamless integrated solution from AI agent to human agent. This lets them manage the entire customer journey end to end. That generates proprietary data, lets them capture the interaction, whether it's a bot or a person handling it. This integrated approach, that's their real competitive advantage against others who might just have like a siloed chatbot.
Got it. And while they were doing all this operational transformation, they were also making some serious moves on the capital structure side. We have to talk about the share repurchases. They were instrumental in boosting those per share numbers, right?
Absolutely instrumental. I mean, during fiscal 25, they retired roughly 23% of their shares outstanding, mostly through that significant TRGI share repurchase. To put that in perspective, that's a massive chunk of their public float. Just poof, gone from the market.
Yeah, 23% isn't just a routine quarterly buyback. That's a structural shift. What does that actually do for the remaining shares?
Well, it creates a much tighter ecosystem for the stock, right? It directly amplified the per-share metrics, obviously contributing big time to the 31% adjusted EPS growth we mentioned. But maybe more importantly for the future, it severely tightens the public float. So any future positive news, another earnings beat, it could potentially lead to highly volatile, strong moves higher simply because there's less supply out there. And remember, they did all this while ending Q4 with net cash of $13.7 million, backed by that record FCF. This isn't a company burning cash for growth. They're fueling growth and shareholder returns with cash flow.
That flexibility, that balance sheet strength, it really sets the stage for looking forward. So let's get into the guidance for fiscal 26. How aggressive is management being here, especially when you compare them to the broader, much slower BPO sector?
The guidance definitely reinforces the bullish case, I'd say. For the full year FY26, management's projecting revenue between $590 million and $610 million. Adjusted EBITDA is expected to land somewhere between $75 million and $79 million. And they're anticipating CapEx, capital expenditures, to be in the $20 million to $25 million range. That reflects continued strategic investment, especially expanding in those high-margin regions like India.
Okay, and for investors watching the immediate next steps, what's the check for Q1 of FY26?
Q1 guidance looks solid, maybe a little conservative. Revenue between $143 million and $146 million, and adjusted EBITDA of $17.5 million to $19 million. Now, let's just quickly go back to that sector context again. IBEX delivered 9.8% revenue growth in FY25. You have to understand that significantly outgrew the broader BPO and CX sector. Many large established players there are struggling to grow more than like a point or two. Some are flat or even shrinking. This execution is a huge validation of their offshore mix and that head start in AI deployment.
You know, I found a detail from the Q&A session that really caught my eye, pointing to that execution quality. Historically, their Q4 is often sequentially flat, maybe even slightly down because of seasonality. But Q4 FY25 was actually up 5% sequentially from Q3. Now, as a skeptical investor, I have to ask, was that just a blip, a holiday fluke, or is management actually signaling sustainable acceleration here?
Yeah, that's a fair question. Management was very clear on the call. They believe this sequential strength is sustainable. It reflects a successful strategy, not just some temporary bump. They pinned this growth anomaly on three compounding factors. First, they're winning significant market share within their existing client base. For example, they expanded their relationship with their second largest e-commerce client into new geographies, Central America, Pakistan, and the Philippines.
Expanding geographically with existing trusted clients. That sounds sticky, definitely less risky than only hunting new logos.
It is sticky. The second factor they mentioned was the acceleration of their digital acquisition business. That speaks to their AI platform's ability to actually win new logos too. And third, and this is huge, in the BPO space, they reported 0 client losses. 0.
Wow.
Managing 0 client losses in a year where many competitors were seeing clients pull back, maybe because of AI integration fears or just budget tightening. It speaks volumes about their operations and how happy their clients are.
That 0 client loss stat really feels like the secret sauce, doesn't it? Okay, finally, on the generative AI front, was there any concern voiced about it eventually commoditizing their service? You know, driving prices down for everyone. They did address that fear, the idea that AI just becomes a tool everyone has. Management remains firmly positive on it. They view Gen AI not as a threat that commoditizes labor, but actually as an evolution of automation that creates new growth vectors for them. By using AI to enable that end-to-end customer journey management we talked about, they can offer these seamless integrated solutions that, frankly, traditional BPOs just can't replicate easily. They're betting that their early lead in integrating this data gives them a kind of moat, allowing them to capture higher value, not get squeezed on price.
Okay, so this combination of strong free cash flow, aggressive but smart capital management, and this defensible strategic narrative, it really creates a powerful setup.
Which brings us nicely to our This Is Not Financial Advice segment. Time to pitch an aggressive, directionally biased train idea based on these core catalysts from the earnings call.
Right. So given the fundamental floor we discussed, the super tight float, and that clean guidance beat, just buying the stock, going long, it almost feels too passive here. It might not capture the potential speed of this re-rating. So we're pitching something more aggressive, a directional option strategy. Think like long-dated call options, maybe a calendar spread, something targeting the stock reaching a new multi-year high. Let's say likely in the $50 plus range, probably within the next 12 to 18 months.
$50 plus, okay, that suggests a significant expansion of the valuation multiple they trade at. What's the catalyst stack supporting that kind of pretty ambitious price movement?
We see three key pillars, all rooted right in this earnings call. First is the fundamental floor. Like we discussed, that record FCF generation. It provides massive downside protection. Plus, it gives them capital for opportunistic M&A or maybe even more buybacks. It really solidifies the valuation floor under the stock.
Okay, fundamental safety net. Pillar 2 relies on that story changing. Right.
Exactly. The narrative shift, the successful move from just AI proof of concept to full-scale deployment confirms IBEX as an, quote, early leader in this AICX space. They arguably shouldn't just be valued like a slow-growing BPO company anymore. They've kind of earned the right to be priced more like an AI-enabled tech services growth story. That shift alone justifies multiple expansion.
Makes sense. And the final pillar, perhaps the most explosive one, is the technical setup.
That's the low float catalyst check. Those massive share repurchases, especially the TRGI deal, have severely tightened the public float. Think of it like trying to boil a small pot of water versus the whole ocean. A small pot heats up really fast, right? So if Q1 FY26 results come in strong, validating that sequential growth, and maybe the company announces some more AI deployment wins, the stock is just poised for potentially violent, strong moves higher simply due to the lack of available supply. Lack of supply plus unexpected demand equals, well, volatile momentum.
So the outrageous but plausible bet here is essentially that the market's perception is going to shift rapidly. We're talking a potential 50% or more re-rating as people recognize IBEX's successful migration, moving from just a standard BPO labor shop to a high-growth, AI-augmented service provider.
They're executing flawlessly while a lot of competitors seem stuck in that older BPO 2.0 labor model, that performance gap. That's the opportunity right there.
All right, that wraps up our deep dive into the IBEX earnings call. The key takeaways for you, the listener, are really the successful deployment of their AI strategy, that robust and high-quality free cash flow generation, and the sustained outperformance compared to the broader, often struggling BPO sector.
Yeah, and maybe the provocative question you should be mulling over is this. If IBEX keeps leveraging its strong net cash position and that powerful FCF to strategically fund these high-return AI deployments and keep expanding geographically, does the market fully appreciate how quickly this company, with its BPO 2.0 legacy, is actually migrating into a high-growth AICX platform? Or is there still significant opportunity left on the table for those willing to look past the old BPO acronym?